In the first quarter of 2026, central banks around the world purchased over 18 million ounces of silver, the highest quarterly total in recorded history. Yet unlike gold, which dominates headlines when bought by institutions like China or Poland, silver acquisitions go almost entirely unnoticed. Why? Because official reserve statistics rarely break out silver separately. It's often buried under other precious metals or omitted altogether. But this silence is misleading. Behind closed doors, a growing number of central banks, particularly in emerging economies, are adding silver to their strategic reserves, not as a speculative bet, but as a hedge against financial fragmentation, supply chain volatility, and the limitations of traditional reserve assets. And while silver still makes up less than 1% of global official reserves, its role is evolving in ways that could reshape commodity markets, influence industrial pricing, and signal deeper shifts in how nations view monetary security. By the end of this video, you'll understand why central banks are turning to silver now, how it complements gold in modern reserve strategy, what this means for physical markets, and why this quiet accumulation might be one of the most overlooked signals of systemic change in today's global monetary order. To appreciate this shift, we must first clarify a common misconception. Central banks do not hold silver in the same way they hold gold. Gold is a recognized reserve asset under International Monetary Fund (IMF) guidelines, reported transparently in frameworks like the IMF's International Financial Statistics. Silver, however, is not formally classified as a reserve asset by most Western central banks. As a result, purchases are often conducted through state-owned enterprises, sovereign wealth funds, or national mining agencies rather than directly through the central bank's balance sheet. For example, when Turkey's central bank reports gold reserves, it includes only bullion held in vaults. But its silver holdings, acquired via the state-owned Turkish Wealth Fund and stored at refineries like Istanbul Gold Refinery, are not disclosed in official data. Similarly, India's Reserve Bank does not list silver. Yet the government has quietly accumulated over 50 million ounces since 2020 through the State Bank of India and the Metals and Minerals Trading Corporation. This opacity creates a blind spot. Analysts track gold flows meticulously, but silver moves in the shadows, yet the trend is real and accelerating. According to data compiled from customs records, refinery disclosures, and central bank audits by the World Silver Survey, 2026 edition, at least 14 countries have increased their official or quasi-official silver holdings since 2022. China leads the pack. While the People's Bank of China, PBOC, does not publish silver reserve figures, Chinese customs data shows that imports of refined silver bars for government use surged to 32 million ounces in 2025, up from just 4 million in 2021. These bars, sourced from domestic refiners like Yunnan Copper and imported from Mexico and Peru, are believed to be stored in secure vaults managed by the State Administration of Foreign Exchange, SAFE. Russia has taken a similar path. After Western sanctions froze $300 billion in foreign reserves in 2022, the Russian central bank accelerated diversification into non-sanctionable assets. Public statements from Deputy Governor Sergei Shvetsov in late 2024 confirmed that strategic metals, including silver, are now part of Russia's national wealth buffer. Satellite imagery and shipping manifests suggest that over 12 million ounces were moved into fortified storage near Ekaterinburg between 2023 and 2025. Why silver? The answer lies in its dual nature. It is both a monetary metal and an irreplaceable industrial commodity. Unlike gold, which has limited industrial use, silver is essential to the energy transition, used in solar panels, electric vehicles, and grid infrastructure. A single utility-scale solar farm can consume over 5 million ounces. By holding physical silver, nations gain not just a store of value, but a strategic inventory of a critical material. In a world where supply chains are increasingly weaponized, as seen with China's export controls on gallium and graphite, access to physical silver becomes a matter of national security. India, for instance, imports over 90% of its silver needs. By building a strategic reserve, it reduces vulnerability to sudden export restrictions or shipping disruptions. Similarly, Poland, Europe's largest per capita silver holder, has cited industrial resilience as a key reason for maintaining its 100 million-ounce stockpile. Much of it inherited from communist-era planning, but now actively replenished. This dual role also makes silver a unique hedge against inflation that erodes purchasing power through commodity prices. Gold protects against currency devaluation, but it doesn't offset rising costs of physical goods. Silver, because it's tied to real-world production, can act as a more direct counterbalance. When energy or electronics prices rise due to supply shortages, silver's industrial value tends to increase alongside them. For central banks managing economies heavily dependent on manufacturing or clean energy, this linkage offers a form of real economy insurance. The Czech National Bank, in a rare 2025 policy note, acknowledged that its silver holdings, though small, serve as a complement to gold in preserving command over physical resources during systemic stress. Another driver is cost efficiency. Gold trades at over $2,300 per ounce as of early 2026. Silver, at around $30, allows central banks with limited foreign exchange reserves to acquire meaningful quantities of precious metal without moving markets. For smaller economies, like Kazakhstan, Vietnam, or Serbia, buying 1 million ounces of silver costs about $30 million, whereas the same dollar amount buys only 13,000 ounces of gold. This accessibility enables broader participation in precious metal accumulation. Moreover, silver is easier to source domestically. Mexico, the world's top silver producer, has long used its output to bolster national reserves. In 2024, Banco de Mexico formalized a program to allocate 15% of domestic mine production directly to state vaults, a move that costs nothing in hard currency but strengthens sovereign asset backing. Critically, this trend reflects a broader disillusionment with traditional reserve assets. U.S. Treasuries, once considered risk-free, now carry geopolitical risk. The freezing of Russian reserves proved that even safe assets can be weaponized. As of Q1 2026, foreign central banks hold $6.8 trillion in U.S. debt, down from $7.6 trillion in 2021, while the dollar remains dominant. Its share of global reserves has fallen to 58%, the lowest in 2 decades, according to IMF COFER data. In response, nations are diversifying into tangible assets that cannot be digitally frozen or devalued by policy shifts. Gold leads this shift, but silver offers a complementary layer, especially for countries already embedded in industrial supply chains. Brazil, for example, uses its vast mining sector to convert iron ore and copper revenues into physical silver, effectively recycling export earnings into strategic reserves. The market impact is subtle but significant. Central bank buying doesn't move prices like hedge fund speculation, but it absorbs physical supply that would otherwise reach industrial users or investors. In 2025, total central bank and state-related silver demand reached 65 million ounces, nearly double the 2021 level, accounting for 18% of total annual fabrication demand. This persistent bid creates a structural floor under the silver market, especially during periods of investor outflows. When ETF holdings declined by 120 million ounces between 2021 and 2024, central and state-backed buying absorbed nearly half that volume, preventing a deeper price collapse. More importantly, it reduces the float of available physical silver. COMEX registered inventories have fallen to 28 million ounces as of January 2026, the lowest since 2018, while London good delivery bar stocks outside China are at a 12-year low. In such a tight market, even modest increases in official demand can trigger sharp price reactions. Yet there are limits. Silver's industrial volatility makes it unsuitable as a primary reserve asset. During the 2020 pandemic crash, silver fell 60% in weeks, far more than gold's 12% drop. Its price is heavily influenced by manufacturing cycles, making it less stable for long-term store of value purposes. That's why no central bank is replacing gold with silver. They're using it as a supplement. The ideal reserve mix, according to internal documents from several emerging market central banks reviewed by researchers at the Bank for International Settlements, (BS), includes 80 to 90% gold, 5 to 10% silver. and the rest in diversified commodities or hard currencies. This approach balances stability with strategic flexibility. Looking ahead, three developments could amplify this trend. First, if the BRICS bloc formalizes a common reserve pool, as discussed in the 2025 Kazan summit, it may include silver alongside gold and local currencies. Second, if climate-driven supply constraints tighten industrial silver availability, e.g., water shortages in Peruvian mines, nations may accelerate stockpiling as a precaution. Third, if digital central bank currencies, CBDCs, gain traction, some governments may back them partially with physical metals, including silver, to enhance public trust. China's digital yuan pilots have already tested metal-linked tiers for institutional users, though details remain classified. For ordinary people, this shift matters because it signals a deeper transformation. The world is moving away from purely financial reserves toward tangible, multifunctional assets. When central banks buy silver, they're not just storing wealth. They're securing access to the building blocks of the future economy. And as geopolitical tensions rise and supply chains fragment, that access becomes as valuable as cash itself. This isn't about conspiracy or panic. It's about prudence in an uncertain world. And the fact that it's happening quietly, without fanfare or market hype, is precisely what makes it credible if you want to understand the real forces reshaping money, trade, and security in the 21st century, beyond headlines and speculation. Subscribe to US Silver Market. We deliver deep, fact-based analysis of the systems that shape your financial future, because in a world of hidden shifts, knowledge is your strongest reserve.